Hey, this is Sasha, and thanks for joining me here for another Let's Talk Stocks session. And today I'd like to share with you the webinar that we just had with the community that are on my newsletter list. So if you want to join me on a live webinar, which we typically do once a month, take a look at the description below where you can sign up to the newsletter list, and that way you're notified as I release new webinars. Again, we typically do a live session once a month that's open to the public, but if you want to take a look at my video membership, we do more webinars more frequently there. In either case, here it is. Here's the webinar. Enjoy. Okay, so welcome, episode number 122. Let's talk stocks for this live webinar. We're going to do Q&As here today and just taking some of your questions from scanning to the trading day to looking at the computer screens. Of course, any stocks that I mentioned here are simply for educational and informational purposes. I don't know your personal risk tolerance. I think you already know this by now, but just to make sure that we're clear, understand that there's no recommendations to buy or sell any specific stock that I mention here. In either case, with that being said, let's take a look at some of these questions here that I have, and I'll see if I can post them. I'm not sure if it'll create a very weird effect or not. Okay, I think it'll be okay. So here, when we look at some of these questions, please show live trading entry point, why, exit point, why, and a stop loss, and why. This alone could be a 20-hour course, I would think, and my plan is to do a trading full circle little mini course live session that we can do. I'm just trying to figure out where I can allocate that time and whether I do it at night and do like a midnight session, but I'll try and touch some bases on this one. How to scan for stocks. Okay, if we look at this one, I've actually covered how to scan for stocks, especially if you are part of the video membership plan. We did a 51 session here, scanning for stock patterns and setup. Review this one, posted January 21st. Very good insight, I believe, for scanning stocks. I'll touch base on it again a little bit if we have leftover time. What's on your trading computer screen, spacing and size of each would be helpful for a 27-inch Mac. Please explain your whole trading day, like how you search for stocks, how you select stocks, and really appreciate your videos and insights. Thank you very much, by Rick Hunt. Okay, so those are the questions that we'll kind of go over. If you have any additional ones, by all means, post them in there. But otherwise, I'm going to hit a few of the easy ones real quick so that way we can just kind of wrap things up and get to them. So first things first, let's cover what's on your trading computer screen, spacing and size of each. It would be really helpful for a novice and with a Mac. If you go to the Traders Fly website, and in fact, I think it's tradingcomputercourse.com. If you just search for tradingcomputercourse.com, there is a free computer course about buying and building a trading computer right here. And if you just sign up for that with your email address, I think it's 6 videos or 8 videos about the computer that I use and about the parts that you should get when buying a computer. It talks about Macs versus PCs, laptops versus desktops. In simple terms, I always prefer a desktop computer, a PC, over a Macintosh. I think Apple is a great company. It's a great stock to trade. I enjoy trading Apple, but I think they're horrible when it comes to the financial world and flexibility. It's also a risk problem because if anything happens taking apart a computer, many people do not know how to take apart an Apple machine. And even myself, I'm very horrible at that. But when you look at a PC, it's very simple. Even a 15-year-old kid these days can take things apart. Now, for me, the other main thing is screen real estate. With Macs, the problem with screens is connecting multiple screens is a little more tricky. When you have a PC or a regular desktop computer, you can connect a ton of monitors. And even for me to do this right here, what I'm doing right now, takes a couple of screens. Now, I would say if you're trading, how many monitors do you need? 2 is nice. 2 is nice because you could focus on your trades and then your charts or whatever it is that you're doing there on the side. As you get larger and you trade larger, right here, what I have is 6 screens at minimum, plus I actually have another computer that's exactly identical to this one right here that has more monitors, and it's just a backup system that I can use. If anything goes down, boom, I can switch to that computer immediately. Now, granted, I have a laptop and some other things here and there, but I pretty much have an identical system, 2 of them. And the reason I ended up doing this was there was a motherboard that fried on my computer years ago. And when that happened, just working on a system and doing the trading that I do and the amount of things that I do, it really it created a lot of headaches and problems. So we had to rush order things, and in either case, it was problematic. So now I always have basically 2 identical computers. If we travel, if I'm capable to bring the big computer, I'll bring the big computer. If I'm not, then obviously it's multiple laptops and things of that nature. But in either case, if I'm looking at my screen, okay, what's on your trading computer screen? And this is actually very simple. To answer this question, since I'm looking at stocks all the time, I'll typically have my favorite list up and just 1 or 2 stocks that I'm really looking at. So it could be, a list just like this, and you don't even have to look at the chart. You could totally wipe out the chart. That is basically all I look at most of the day. Okay, I'm only looking at price because to me, price is key. It all comes down to price. It's not about, how the chart is, because I already know what the chart is. I've already done my research. I've already done my homework. So all I'm really looking at is what's the change. I'm looking at mostly what's the change, what's the current price, how's it moving. Now, I might look at the daily chart and just kind of see, okay, well, how's it behaving today? But in general, I know the S&P 500 is near 2,300. I know that. So I know that if today it's up or down two points, it's not going to really matter. It's still around 2,300. So the same thing. Once you get familiar with your stocks, Apple's around 130. So now you say how much, right? So I'm basically looking at price. If from time to time I get a little more detailed, and if you're using like a Thinkorswim platform, you might use a screen like this. So it just depends which screen I have up. Either way, the point being, all I'm really concerned about, and even though there's many other fields, I don't even worry about this open and high and low. These things could even be removed, but there's plenty of space here. For me, I'm mostly looking at right here, the last and the ticker, and then I'll also look at the net change. Okay, that's it. So if I'm looking at Apple, that's all I'm looking at. If I'm looking at Amazon, I'll look right there and I'll look at the net change. Very simple, not too complicated. That's all I need to know. Because if I'm in Amazon at $800 per share and it's up, let's say $8.18, from yesterday, I already know where the stock is. I know my position, right? So since I already know my position, I know what's going on with that stock. I know what's going on with my portfolio. So that's kind of what I do. Spacing wise, I actually have it usually a little bit smaller. This is simply because just to squeeze more things on the computer screen. And but for shooting videos, I do make things a little bit larger for you guys, so that way you don't have to squint, or if somebody's a little bit older, they can view the videos a little bit easier. So, but in general, this is pretty much my simple setup. You don't need things more complicated. All you need to do is really hone in and focus on the price. Now, when I'm scanning, obviously, I'm just looking at charts just like this, just one screen at a time. I'm scanning things, and I'm looking for price points, and I might set some alarms and alerts and those kinds of things. But overall, I'm really, once I'm in a position, most of the day, I'm looking at the price. I'm not usually worried about the chart for the day. I'm not worried about $1 wiggle room here or there, because I'm looking for longer moves, or I already know the behavior of the stock. The intraday wiggle room, it's going to happen in quite a bit of the day. It'll change. So that's why you always look for 1 or 2 days follow through for patterns and things like that. Okay, so please explain your whole trading day, like how you search for stocks, how you select for stocks, the stock you want to trade, and how you trade. Again, very complex question. I would say it's tough to answer this very quickly. But I'll give you a little rundown, okay? So in general, and it really comes down to my personal lifestyle too, obviously. In general, it really depends what I'm doing, and the day before that. So I do have a son. So since I do have a son, I spend time with him. And depending on if he goes to bed late or he's had a good day, bad day, that really kind of dictates partly my trading day, since the flexibility of that allows me to do that. But the starting point of the trading day actually comes back to the previous day. Okay, so if I look back at the previous day, that's kind of where my trading day ultimately starts. So I typically will do scans or scanning stocks. Now, I also do this for you guys as well, but I typically do scanning in the evening. Okay, so this might be at night, either before dinner, after dinner. It could be just nighttime. This may happen anywhere between 2 times per week, depending on market conditions, to 4 times per week. Again, the more violent or volatility, so if you pay attention to the VIX, the more violent the VIX is, the more I scan. And the reason I do that is because stocks are moving more violently and they move more quickly when the VIX is high. If the VIX is really low, like right now we're in a low environment, let's say the VIX is at 9, okay, I might scan once a week, and that's even more than enough. You know, back when I didn't used to do charts for the website and things like that, I might do new scans or fresh scans once every 3 weeks, even with a low VIX. But nowadays, I try and do scans a little more frequently for you guys. So in general, it really comes down to the VIX. Now, I usually will scan in the evening and, either post those things or just catch a few things or review a few things. And that's when I do most of my scanning. Now, it comes down to if I stay up later and make or film a few videos, because sometimes what I'll do is, depending on the week, I may go ahead and do some filming late at night. And this is for things like the Tuesday videos that I put out. I'll usually pre-film those months in advance. So for example, a topic on like a Q&A, somebody will ask me about, let's say, computer screens or something like that. If we post a video on Tuesday, we already have things that are lined up in, let's say, March or even April that go out on Tuesday. Now, the Thursday sessions, I can't really pre-film those because it depends on market conditions. I may have 1 or 2 in the queue that I'll do just in case we go on vacation. But in general, most of the time, I'll do some of the nighttime filming at that time. Sometimes it's during the day, but we'll get to that. So in either case, my main scanning happens right here. And then after that, I'll probably go to bed and so on. So then I'll wake up, and in the morning, what I'll do is I'll check the futures. Okay, so the futures just tells you how up or down the market perceive things. And this is just future contracts. It's not necessarily going to dictate the whole day. I'm just looking at where's the energy of the movement. In general, looking at the previous days already, okay, what happened yesterday will kind of tell me anyways what's happening the next day. So if the market was weak, acting sloppy, it'll probably happen again the next day or sell off. If the market was strong the other day, you'll probably see a follow-through day. If it was too strong, and let's just say you had an extreme move to the upside, you'll probably get a slight little pullback, even if it's just halfway. So again, it's all relative depending on the previous day. So I'll check the futures, and I'll see what's going on there with future contracts and how the S&P really is moving. That's my main concern, is really the S&P. Even though the NASDAQ composite moves the stock, the S&P is where I look at the futures, because that's what I'm looking at. And it's just a better predictor of the overall market for me. Then what I'll do is, you have your morning breakfast, you do your workout. There's a lot of things in between there as you create a morning ritual, which I cover in the Trader Transformation course. But as far as trading goes, once we get into things and we get into that 9:30 opening bell, I kind of sit still. I just sit on my hands. I don't really do much. I'm just watching the price action and price behavior. If the price is good or price is strong, you see a lot of people buying in, and my pricings from the scans that I did in the past start hitting, I may nibble a few shares. Okay, so I might go in, let's just say if I'm looking to get in 500 shares, I might get in 200 shares if it looks good, but it's too early. And the reason I say that is because you may get a reversal if you're right at the opening bell. So that's why usually I sit on my hands. By the time you hit around 10:30, I want to be filled into partly most of my contracts or shares. Again, this depends on the VIX, the market conditions, and many other factors. But let's say I might get in another 200 shares here, and then you kind of have a 400 share position. Now, in the next day, you might get in more shares, right? So I don't put all my position on usually on the first day. I usually will spread it time-wise throughout multiple days, depending on the size of the position that I'm looking to get in. Obviously, I'm not a hedge fund, so I'm not splitting it up for multiple months, but I will split it up for multiple days, just in case we get a day pullback, like the next day or the day after. But other than that, if I start looking at, let's say, 11 o'clock, 12 o'clock, if things actually don't happen around this time and there's no breaks and I'm already in positions, again, I just sit on my hands. What I actually may do is I might actually write another chapter in my next book. I might just watch and monitor my positions. I'll work on a video. I'll edit a video. I might, do a little quick webinar, such as one of these right here that I'm doing. So it really comes down to overall the market, my current positions. But if things do start breaking out, let's say at 1 o'clock, and this is the time they break out, then that's where I get in the position. So again, it really just depends on when this happens. And then the rest of the time, you're kind of doing your own thing because you don't need to trade every single moment. The act of trading is simply just getting in and out of positions. But being patient is what allows you to make money. So you're patient when things run up, you're patient when things run down, you're being patient doing and executing your plan, not doing and executing the trade. You don't make money by trading more frequently. You make money by doing the right trades and taking money off into strength, right? So that's what I do. I mean, that's just a general rundown of kind of the day that I go through. And then again, as we approach, let's say 3 o'clock, 4 o'clock, at 4 o'clock, you want to do a thing called a fire drill. And this was coined by Dan Sheridan, who does option trading, really nice guy. I really like him. He taught me a lot when it comes to options. And by 4 o'clock, you want to do a fire drill. So you're looking at your position and you kind of say and you evaluate. So let's say I'm looking at stocks right here and I say, okay, I'm looking at Ameritrade here. And I'm at, let's say, 3 o'clock, 3:30 in the afternoon, and you do a fire drill, meaning, well, what happens if this stock tanks tomorrow? Or what happens if it explodes tomorrow? Now, if you're in a good position, you should be fine. If you're in a tight position, you might want to take half off, a third off, a quarter off, something like that. Put on an option trade, do some little adjustment, things like that. Those are things to think about as you're positioning yourself because you're looking at the lay of the land. How's the market set up? How's the market positioned? That's kind of what you're looking at when you're doing that fire drill at 3, 4 o'clock. So that's kind of gives you some insight there throughout the day. And then by the time you hit 5 o'clock, you spend time with the kids. If you're doing lunchtime, again, I might take a little bit of time there for lunch, might read a little bit, learn a little bit. So those kinds of things are just personal related time. But if you're looking for stock related things, this is kind of the way that I work through the majority of my trading day. And throughout there, sometimes, during that morning session, if nothing's happening, I may scan through stocks during this time. If something's happening and I'm doing things, then I may scan for things a little bit later. It's different depending on the day, but this is kind of the majority of what I do. Because stock trading, you have to be patient on when to take action. It's finding those opportunities and moments, not necessarily looking at, okay, well, at 9 o'clock, I'm putting on a trade. At 9, or 9:30 I'm putting on a trade. At 10:30 I'm taking some profits. You can't really do it in that way. So the flexibility of trading, one of it is really powerful. The other hand, for many people, they think it's really boring because there's not much to do. And, you wonder why or how am I able to write the amount of books that I do or the videos that I produce? Well, it's because of this, because once the position is there, and if looking at, let's just say some of these stocks, you look at, well, take Ameritrade here, for example, on the weekly. Once you're in the position, if you're in the right stock and you get into this stock right here, how many weeks are you in that stock? Look, you're in that for 1.6 months where you're not maybe doing too much. But you're letting your account kind of sit and create money. The same thing, whether that's an Apple, whether that's a Netflix, whether that's a Facebook, that's what you do. When you get in and let's say you had 1, 2, there's the double bottom. Let's say you had a triple bottom. Even if you didn't get in right here, you got in right here. Let's say you got in late, okay, somewhere around there, or even right here, that's still a good month where you're just kind of sitting on your hands. You're being patient. And that's what you do. Why do you need to search for more stocks or search for a different position? It just, it's when you have 50 positions on, and I used to try to do that. I said, oh, well, I'll diversify. I'll have one position on this stock, one position on that stock, one position on another stock. When you have 10, 12 positions, it starts to becoming a management problem, especially if these things pull back in a big way or you get a market down move. It really becomes a problem. So I'd rather have 3 to 5 positions. Even if you're trading a $5-10 million account, 3 to 5 positions is all you really need. It's a lot easier to fix those things if they go against you. But here, you let these things ride, and you might look for another opportunity or speculative play. But ultimately, I like to keep things simple. For many people, it's the patience that gets to them. They don't know or they don't learn how to be patient. And but that's just kind of a quick rundown of the trading day, to give you some insight. Hopefully that gives you some insight. It's not exactly day to day to the minute of what I do, but it'll give you some insight. And then, okay, so the other thing is entry, exit points, stop loss. And then I was interested in how you trade in a bear market. Might not be related to this webinar. No, any questions are fine. So let's tackle this one because it's a new, different question. Trading in a bear market. Okay, so bear market, it's important to understand that when you're trading in a bear market, a lot of good traders love bear markets, okay? Many good traders love bear markets. Me, myself, I also love when the VIX is high, not too high. I'll give you a nice sweet spot, okay? So there's always a sweet spot. Just like buying a car, when you're buying a new car versus a used car, there's always that sweet spot because you have the depreciation and so on. But here, if we look at the VIX, my favorite time to trade, and I'll give you here a little quadrant, is probably when the VIX is right around 13 to about 18. That's kind of a nice sweet spot to trade. When the VIX is low, like it is right now, it's actually quite horrible to trade for traders. I can't draw that line, but there you go. So when it's quite low like this, it's actually horrible for people who are more experienced, people who like to be more active in the market. You'll also find with time, as you become better, you'll hate it when the VIX is low, because when you have a low VIX, what does this mean? It usually means the market continues to head higher, which on one hand, for the normal mom and pop, this is okay because they just put in their shares, they buy some shares, they let things sit, and they want to get appreciation from dividends and things like that. That's what most people that invest on a general basis, that's what they want. They want to just put their money in and let it sit. For active traders, we actually like a little bit of a higher VIX. The reason we like a higher VIX is because you get volatility. With volatility, you get movement. So how do you make money from the market? It's through movement, price, which if we go back to our original question or earlier question, why do I only look at price? Well, because it's based on price. The market is all about price. Volume is also key. You've heard me stress volume, but volume confirms the price move. It tells you how much gas is in the tank, right? But price is what I'm looking for. I'm looking at the price. So when I look back at the VIX, I like it to be in that nice little sweet spot. It's a nice little range, somewhere around that level. 13, 16, 18, that's a good sweet spot. A little bit under 20, but not too crazy. Because once you get into these high levels of over 20, or when you get super high spikes, like over here you had a 50 VIX, these little topping areas right here could actually be a little bit in the 30s and 25s. Could be dangerous because a lot more panic goes in, and it's irrational exuberance. People get really crazy, and that actually can be very dangerous. But when you're in the nice sweet spot of 12, 16, 15, 18, that's a really good time, because all of a sudden what you can do is, when you have a little bit of a higher VIX, you can trade more. So when things get extended to the downside, you can go ahead and load up on some shares. When things get extended to the upside, you can take some profits into strength. So just like with Amazon, if we take a look at this, you can see once you get too far extended down here, you can load up some shares. Even if you loaded up some shares here, that it's a fairly big pullback already. So, you might have to endure some problems right here, just a little bit. But the bigger picture, you're buying when everybody else is selling, right? Being the contrarian, and you're selling when everybody else thinks things are good. So as this stock continues to move higher, that's why I always say sell into strength. So you're selling and peeling shares off. It doesn't matter where you do it. The important part is that you do it. Do something to take profits off into strength. So again, as people are panicked, right here was our earnings. You could have bought some shares right there and made a good $20 move in that stock. Now, granted, it's moving again up on weaker volume, but you understand that it's slightly overextended there within a day or two on the shorter term. So we like a higher VIX as you start trading. And with bear markets, you have to also remember the bigger picture. Most of the time, when you look at bear markets, when do they happen? Bearish markets have happened at least on an easier time frame. Really, in 2008, 2009 was a big bear market, and in the 2001, 2002 was a big bear market. Now, there's some little issues as well in 2011, 2012 that happened, and a little bit right there, that's just little sideways consolidation. But the majority of the time, most of the time, this is why they say buy on the dips, most of the time stocks continue heading higher. And they'll kind of continue doing that throughout time in history until our fiat currency, or the dollar, will collapse. I've talked about the stock market bubble in the past, and they'll keep pumping it because they'll keep trying to save it. They, meaning the government, meaning these industries, they'll keep trying to save these things, because otherwise you get a world of chaos. Imagine if the dollar was not worth anything. I mean, if it's just paper now, you just use it for fire. We only get value from it because we assign a mental and psychological value for it. So eventually the dollar will collapse completely, just like previous currencies in the past during the Roman years and so on. They always do. It's just a question of when. So what can they do to sustain these things? Well, even if we get a large market pullback, let's just say we get it to 1,500, and let's just say tomorrow is a bad day and you get a bad week and a bad month and things start crashing. Not saying that they would, but let's say things come back to 1,500. By the time these government people start seeing these things, it takes a couple months, right? Just like in 2008, 2009, it doesn't happen in a day. So they start seeing these things and they'll try to jump in and intervene and bail out people. And again, now that we reverse Dodd-Frank, banks can do whatever they want and so on and so forth. So less regulation. Anyways, point being is by the time they hit, let's say 1,500, and let's just use that as a support line, what they'll do is they'll just print more money. And when they print more money, what does that do? Well, it lowers, since there's more money in circulation, it lowers, here's the DXY, the US dollar index, and this is what Trump is ultimately doing. You can see the dollar now is heading lower, which is not very good for Americans. Because if you look at the overall job rate, we're actually at the lowest job unemployment rate in history. But very people were still unsatisfied to elect and nominate Trump. And why is that? Well, people aren't happy with the salary probably, or their wages. So they have jobs, but it's not the jobs Americans want to do. So how do you make that change? Well, if Trump kills the dollar, which he's basically doing right now, ultimately what's going to happen is you're getting this pullback in the dollar. And as you get this pullback, the last time we had this major pullback in the dollar, if you take a look, was really during the Bush era right here. So that was after Bill Clinton. So we had this Bush era right here. The dollar got crushed. And when the dollar gets crushed, they print money. Remember those checks you used to get, for stimulating the economy? This is what happens. And when you crush it, that means when you go travel to London, when you go travel to Japan, whatever, you go to another country, relative to the rest of the world, America then is not doing very well. When you look at it in terms of trading in the economic sense, also, America is not doing very well. This is just a way to boost the trade. But you personally, if you stay in the American bubble, you're perfectly okay because, the stock market goes higher. This is how they pump the stock market. Because if you look at one of my old videos, when the dollar goes down, in theory and technically, when the dollar's down, stocks usually go up. And the inverse is true. When the dollar goes up, typically stocks go down. Now, they can work both together, but it usually doesn't happen. But they can. When they do, just like when bonds go together, the dollar goes up and everything, that's a real booming economy. In our case, we're getting higher stock prices with a lower dollar, which means it's basically manipulated. We're doing it through, by hurting ourselves relative to the rest of the world. So how do I trade in a bearish economy, getting back into things? Well, what you have to remember is that when stocks sell off, they sell off usually for a shorter time period, and then it takes much longer for things to go back up and higher, or at least to get back to the same point. When people are in a panic, they sell off much faster than they go up because it takes more energy to push a rock up a hill, up a mountain. It takes more energy to do that. When stocks sell off, they go quicker because they're emotional. Okay, they sell off much faster, but they sell off much faster, but it takes longer to recover. Okay, so it's a shorter time period. Basically, between this to this time period in 2008, 2009, you have 1.4 years that it took to be able to sell off those stocks, and to be able to get back in there to that same price level, you basically took 4.2 years. So quite a bit longer when you look at it. So to trade in a bear market, what do I do? Well, I will typically short. I mean, that's the simple premise behind it. I'll put on hedging positions. I'll put on, depending on how the market's set up, I'll put on hedging positions. I might sell upside calls. I might buy vertical puts. The concept's still the same, but I know that my holding time period, anytime you short, whether it's a stock, even up here when you're shorting, whether it's a stock, an ETF, it's for a small time period. Stocks go up or can go much longer to the upside than they do for the downside. The downside is limited, and you'll make much more money going to the upside. The only problem is when they break to the downside, it's usually much more violent. So you can make more money in a smaller period of time when you short, okay? But you'll make more money in the long run by going long. So I hope that kind of makes sense. I know it may be a little bit confusing, but that's the simplistic version. So how do I do things? Is it any different? It's just you're trading a little bit differently because the VIX is higher. You have to remember the VIX here is going to be higher. So it's easier to sell option premium like the calls. It's also when you short things, they break and you're always taking profits into strength, buying back those shares quickly because you don't know if the bounce is coming next right here, because you'll get a pretty violent bounce because you don't know right here if this is a bear market completely or just a bear little segment. And that's ultimately the problem, because after things pull back too far, they'll snap back. And that's what happened with Brexit. That's what happened with the election here. That's what happens when they overextend on one side, whether it's to the upside or the downside, they'll snap back. So you have to be more quick to take your profits in a bear market. So hopefully that makes a little more sense. Okay, so as far as entry points, exit points, stop loss, and why, we've already talked about how to scan for stocks in one of those videos. But looking at entry points, exit points, if you've looked at the charts, typically I like entry points. Here's a quick little rundown. If you want a formula for entering stocks, why don't we do this? Because some people like formulas. So this is what I really look at. Okay, the main thing about the formula, and what I'm looking for is price. Okay, again, price, volume, and then behavior. Okay, or price action. Some people like to call that price action, which would be this behavior. Let's see if I can spell it right here while I'm talking. So in either case, you have price, volume, and behavior are the main things I'm looking at for. So when I'm looking for price, I'm looking for a main break in support or resistance. And I'm looking for, on a percentage basis, I don't want to give you a number, but it's not exactly, let's just say a stock is trading at 100.03. It's not exactly 100.03. It might give me, I might get into it at 101.27. That is a better approach for me personally because it gives it that wiggle room. Volume confirms this move. Without volume, I know that price will just roll over. Okay? And the same thing with behavior. So even though a price and volume might be there, if that stock has been sluggish in the past, if it's been weak in the past, on the breaks, right? Just like knowing your friend, if you know that they're constantly late, constantly sluggish, even though one time they might be on time, more than likely that behavior isn't going to last. So the same thing, if this stock is acting weak, and even though it breaks and there's some volume, you're still looking at the behavior. With volume, I like to see at least 20% more volume. Okay, 20+%. You can read this from the William O'Neill, How to Make Money in Stocks. He talks about William O'Neill, How to Make Money in Stocks. He says 20% is what you're looking for. And the reason you look for 20%, I like about 20% in volume, is because when companies are reporting, just like they report the earnings reports right here, if I tell you sales are great, okay, it doesn't matter which company, sales are A+, okay, product development is, let's say, an A. Our company satisfaction or earnings and profits, here's my profit sign, are also, let's just say it's a B. It's good. And our future outlook is also, we're going to bring jobs back or whatever you're doing back to the U.S. Let's just say that's an A. So all these things look great, but what most people don't see underneath these earnings reports, and this is where it fakes out a lot of people, is these companies, which you don't realize, most people don't realize, they hit these earnings, and I know how they do it. I've talked to people that work for these companies. The way that they do it is, it's even disgusting to talk about. They, number one, pre-ship things. They pre-ship goods ahead of time for the next quarter so they can hit the earnings in this quarter, and that way they can worry about the next quarter later or try to move it into December because December is a bigger selling month during Christmas. So that's what they keep trying to do. They keep trying to pre-ship things. The other way they do it is through cuts of jobs, productivity, automation. And you don't see that. The job cuts, they kind of do see those things. You might be able to see those, but they don't mention these in the announcements. Usually what they do is they cut the jobs, let's say a month after these earnings reports. So by the time they go 1 or 2 months later to get the earnings report number 2, the second one, you forget about the job cuts that they had to do. And you're not realizing that they're in fact cutting jobs to be able to hit those earnings. That's what they're doing. I mean, you look at Carrier, what they did with Trump, all of this is a facade. It's a game that they play, bringing back jobs. But Carrier is spending most of that money on automation. So think about the bigger picture. What's happening here? This is what happens. They pre-ship things. They cut the jobs. They automate things. They're not really hitting these sales figures. And that's why when you look for earnings, and you look for earnings of, let's say, January 1st to January 1st of 2018, you compare those. Because if you compare the let's say October to January and the earnings are higher, seasonality is a problem. People don't shop the same way between October and January. So you compare January 1st of 2017 to January of 2018, and you see if it beat it by 20%. If they only beat it by 5%, you probably had either pre-shipments, job cuts, automation, a lot of other factors that they do. I mean, there's just so many other ways that they try to hit their earnings. That's their goal. They have to please the shareholders, right? So that's why you look for 20%. And volume is the same thing. So you look for price, volume, behavior. So if I'm looking for a stock to break out on Apple, I see the breakout right here, but I'm looking for 20% above the daily average. How do you calculate 20%? Just use basic, simple math as you're in the day. 6.5 trading hours in a day. You look at how long you've traded, right? So let's just say you're 2 hours into it, and how much volume do you have? And you use some math formula. I do this in the green course to show you how you calculate it like midday. But even if you don't do that, you can see that this one right here broke the volume on the moving average in general. Is it more than 20%? Doesn't appear to be. But with the earnings that you had right here, obviously that's more than 20%. But that's what you're looking for. If it doesn't happen on earnings, I would much rather see it on a regular day, kind of like that, because that shows conviction that people want the stock before even earnings or not during earnings. But you're looking for that 20% because of these exact factors. Because if you only get 2% break, 1% break, what you'll typically then see, and if you just look at what these stocks do, you'll see this little breakout. There it is. It's a fake out. And you can see how we line it up right here. And you can line it up right here perfectly. You'll see that breakout right there. And it fakes you out. You get in it. And then it sells back off. Because why? The volume was weaker here compared to the previous point. Look at it. Just do some basic calculation. Look right here. This week, or that week on October 30th, 2015, we had 322.2 million shares. Okay, that's to the upside. We tried to push higher on 195 million. Okay, so 322 and call it 200. Look at the down volume here. 384. 384 compared to 322. It's on the same price level, right? You take that price level, look at the same price level, compare it over here as well. But you compare that bar to that bar right there. You see 384 versus 322 versus 200. Do you think it's going to go higher on 200,000 shares? It may for a little bit, but there's no volume. So that's why I'm looking at all three factors: price, volume, and behavior. If you want to take some notes, I'll show you that screen again. Price, volume, and behavior in order to see whether that stock is going higher or if it's just a fake out. If you only have two of these, if you just have this one and volume, but you don't have the behavior, it could still go a little bit higher for some time, but the conviction is not there. If you only have price and you don't have volume and you don't have behavior, can stocks continue to go higher? Absolutely. Price is number one. Just remember, price is number one. But it doesn't mean it's sustainable, because if you don't have gas in the gas tank, can a car still move forward without gas in a gas tank? It can if somebody's pushing it. It can if it's rolling down a hill. But how long can you do that? How long can you push a car for? How long can you move it without gas? You're going to eventually get tired. That energy of you pushing it's not there. You're going to have to go pick up some food before that. So in either case, I hope that gives you some insight to what I'm watching when I'm choosing a stock. So let's just take a look here. What else? Entry point, exit points. Okay, looking at some exit points right here. Same thing. As we get into resistance levels, by the time you're already in the stock, wherever you got in it, by the time you're getting in it, when When it's a green day, when the sun is shining, when there's a rainbow, everything looks good and people are screaming, this is a great market, that's when you sell. When do I sell? That's when I sell. I sell when everybody else is saying it's great. It's a great time to invest because I know things are going to pull back soon. I know the bigger picture. I know the game these things play. And, I used to be naive about it. I used to say, oh, it'll continue going higher. They know better. These people know better. But you got to remember, they're just reporting what currently is. Okay? So the same thing here. As these things continue to move and power higher, you're taking half off. If you want to take a third off, fine. If you want to take a quarter off, fine. A fifth, a tenth, it's up to you. But you're taking something off the table. You're taking it off to reduce your risk. That's when I take my profits. And when things pull back, you might go ahead and buy a little more. So the same thing, if we look at Facebook here, right, and you look at this movement, so let's just say you got in this stock right here, okay, somewhere around this level. You might have taken some quick profits over here because it's getting a little high. Fine, whatever. Comes back, does a bounce, you might add to the position. Then you take some more off into strength. Pulls back, you're adding because everybody's selling. And then, again, taking profits off into strength before it gets into this resistance level because I already know resistance is there and there. So I take some off before I get there because what if it rolls back over? Now this one cleared, so you just sit tight. You sit tight. And then again, things continue, it consolidates. You might take some more as you get into this gap level right here, take some more profits into strength. As you see it pulling back, maybe on a red day here, you add to the position. You add back the shares that you sold somewhere over here. So that's how you play the game. That's how you do it. And you're taking profits. And a stop loss, you normally give it a couple of dollars, depending on the size of the stock. The larger the stock, the more wiggle room you need. And you base it on support and resistance. It's not about how much you're willing to lose. It's about giving it enough room for the technicals or price levels to get in your favor in the buy side or the sell side. So as we get into this right here, you can see you could have probably been stopped out here, here, here. Okay, even if you got in it somewhere over here, you could have gotten stopped out a couple of times in this level. Okay. And that is because of that wiggle room that you need to give it. And that's why I always give it a couple of dollars. If it's a larger stock like Priceline, Amazon, $5, $10 stop minimum is what you need. If it's a smaller stock, it can be a little more precise. So with Amazon, you can see right here, we hit this price point. The high was 801.77, okay, whereas the high over here was 884. So it broke the 800 by 84 cents. This one broke it by $1.77. So that's why I say $5 on this for a wiggle room would be pretty good because they whip around much bigger. They're larger stocks. They will manipulate you much differently. So that's kind of how I position the stop, is that I give it a few extra dollars, whether that's if you're shorting or you're buying on a dip, you give it a couple dollars, no matter what you're looking at. So if, let's say, we're looking at this $800 level for a value buy, you might put your stop at, let's say, $7.92, $7.95, $7.94. Not a perfect round number, but somewhere $7.96 and 37 cents, whatever it is. You make the decision. But that's how you approach the stop loss, because you need that wiggle room. Ultimately, again, it's a stripped down and simplified version of it, but I hope it makes sense. Okay, so let's see, what else do we have? If we have any other questions, I have a critical charts questions. Can it be asked here? Sure, by all means. Do you give buy and sell signals like trade room or just going over different charts? No, I actually prefer to simply just talk about charts specifically rather than give you buy and sell signals, because ultimately I'm not an advisor for you. I don't recommend buying or selling anything because I don't know what your trading style is. I don't know what risk tolerance you have. The way that I trade might be completely different than the way that you trade. Your goals might be completely different. Your account size might be different. And I might move things a lot quicker. So I might move into a stock and put on a trade and then sell a few into strength, and other people prefer to hold it. So I don't do that in terms of to limit you on information, I do that in order to protect, number one, myself from advising you on things that maybe you shouldn't be getting into, where I could be giving you bad information. And number two, protecting you as well from making the wrong trading decisions that are not set up for you. My ultimate goal is that you think personally on your own so that you can learn to trade, so you understand the concept and the theory, not necessarily to just give you exactly, oh, this stock looks good at 745 and you should get in it. So that's not my goal, because eventually as I die or pass away, or maybe who knows what happens, then you can at least trade on your own wherever you might be in life or whatever situation or circumstance you're at, because your goals will change over time. So that's ultimately my goal, and that's why I don't say precisely where you're going to buy and where you're going to sell. It's ultimately based on your decisions, because your risk tolerance, risk levels are much different than anybody else. It's like finding a match or a mate, in a dating relationship. Is this one person or woman going to be good for 50 other people? Probably not. You find your match and it might have not worked out with the last 5 people you've dated, but eventually you find the one that works for you, and that's what you need. That's what you're looking for, and you stick with that person. And the same thing, you find the stock or the types of stocks that work for you, just like friendships, and you stick with those, and you'll typically trade the same stocks time and time again. The point of looking at other stocks and charts is to get a feel for understanding how the market behaves. It's to learn the concepts and dig deeper. Eventually, you'll start to spread out your knowledge and education, and you might trade 1 or 2 stocks that are a little bit different than your norm for speculative positions, but in general, you'll probably trade the same stocks for multiple years at a time. Like for me, let's just say Amazon, Apple, the Facebooks, the Netflix, the big boys, the leaders. I like those kinds of stocks. They have options. They have a lot of different things you can trade. So the same thing for you. You might find your sweet spot, and you trade those stocks for maybe 5 years or 3 years, and then you might move on to new stocks and new things as you learn more knowledge and information. But I will tell you, the reason I trade these bigger stocks is bigger stocks move faster. A $5 stock is only going to go up 20 cents, 50 cents. Bigger stocks, they go up much faster. So again, there's less manipulation. There's a lot of positives. There's also a lot of negatives behind any situation. But to me, the positives outweigh the negatives when trading the bigger stocks. Yes, you trade less shares, but there's so many other risk reduction things that happen when you trade larger stocks that it just makes it much more favorable, especially as your account size grows. You'll slowly start moving into those areas. Okay, can you look at NG again? It is trying to, in the money leg, I'm trying to figure out the projected move. I get 166 projected move from 4.96, the low, the consolidation. Am I seeing this completely out by 662? Okay, NG. Let's take a look at NG right here. I mean, this one, let's again review this. Monthly, I always check the monthly. Okay, if we're looking at NG, since I don't watch this stock, every single day or week like I do some of the other ones. So I look at the monthly, I zoom in, looking at the weekly, and then I look at the daily. So depending on where you got in it, if you're looking for out by 662, so 662, you're looking for this price point right here. So that's kind of where you're looking to get out. Yeah, I mean, the stock is already fairly extended. I mean, can it continue going higher? Absolutely. You have a few price points right here also that could be a little bit of trouble right now, because you can see on the daily, we actually broke on the daily right here at the $6, but then it rejected. So it's the confluence. I think with time you may see it break. It does have some recent volume that's picked up, and it did break out here. It just may take a little bit longer. Looking at this, I always take profits in the strength. That's the thing. When things look good, and now if I look at this, okay, do I have price? Okay, price looks good depending on where you got in. Let's see, did you say where you got in? Move from 496, 496. Okay, if you got in at 496 around this price level, okay, if you got in around this price level, By now, for this kind of stock, right, it's a lower dollar stock, and if you're looking at the smaller ABCD pattern right here, it's good to take some profits as you start getting into bars like that, because that's a pretty big size bar. So by now, I would have taken maybe a third off, a quarter off, or half off. And then as you see it coming into this resistance level, it could be another opportunity to take some more off. Now, if it clears, you could let the remaining shares ride and use the $6 as your full stop, because now you've already taken some profits. Will it break higher? I have no idea. So you look at things like price. Price looks so far so good. Price looks good. Then you look at the volume. Volume looks okay. It's not amazing, but it looks okay. If I back check, let me just see here one more thing. The volume here compared to 11.6 million, 11 million. Here we have 8.5 and 10.7. The volume, and it's picking up right here. So the volume is slightly weaker than what we sold off here. So can we go a little higher? We can, but it's slightly weaker. This is what concerns me a little bit. We do have a little pickup of volume, but it is weaker than over here in the past in August, September. And then I look at the behavior. What is the behavior? Well, what's it trying to do? It tried to get up into $6 price level, and it rejected it. Tried to get up again and break it, and now we're still under it. So again, it's kind of sluggish on the break. It's possible because it had this big bar right here just a couple days ago. So it's a little sluggish. So those things I would say are a little more caution things to watch out for. But you do have price, volume a little sluggish, and it's acting sluggish. So, again, depending on where, if you didn't take any profits, I would definitely take some profits. I personally would. Ultimately you have to make that decision. And then you could see, okay, well, will the rest ride? Will it get to 655 as what you're looking for, or 662, in that price level? It could, if it breaks out of the $6 range. And then if you take a look at the monthly, let's just see where we're at, because this ultimately brings us back way over here, okay, and even all the way over here to this bar in 2007, because the lows of that is 587. So again, there's still people probably in this $20 range that are trying to get out even at the $6 area. So that's the thing that you're watching is these longer term values still. So could it get there? Yeah, it could, but it's a little bit sluggish for the moment. So that's just my thoughts on it. You're welcome. You're welcome. I mean, a stock can do anything, right? I mean, you can have a stock moving up on low volume, and very crummy behavior, and it'll still go up, and it fools a lot of people. But your highest chance of success is when all three things working together. That's when you get the highest probability of success, highest chance of success. And that's why I try to focus on those kinds of moves rather than just, it's moving up. Because if it's just moving up, well, if there's no gas in the gas tank, if it's a weak acting stock, if it's the behavior's not there, if it's manipulated, why would I want to trade it? So anyways, you look at every stock when you make that decision and when you set up that trade, when you set up the plan, just like in a chess match. Thanks for watching this week's video. Don't forget to hit the subscribe button over here so that way you're notified as I release new videos, or get on my newsletter list by clicking the button right over here. So that way you can sign up for another live class or live session with me. Thanks again, and I hope to see you next time.